Got a great question to kick us off and talk about this topic from Troy. He says, my dad is set to retire soon, but isn't sure he should pay off the house first. With $250K left at 2.5%, he wants to keep the money invested. Is there something besides that 2.5% interest rate that he should consider? What do you guys think?
Ooh. So let me answer the second part of the question first. Is there something to consider other than the interest rate? Of course, absolutely. When it comes to personal finances, you don't want to ever look at anything in a vacuum. So there are other things to consider. But I like the way the beginning of the question started, Brian. I want to know your answer to this question. Is it okay to retire with a mortgage? Yes or no?
Look, the ideal is
no, yes or no. Right,
well, no, but here's the ideal is that you want to retire debt-free, because it's hard to say you are financially independent while you're sitting there walking around with an obligation. But that's one of those things, in theory or on paper, that is the ideal. But we all know, and this is where the personal or personal finance comes in, it depends. And Troy did give us some context there. I will tell you that 2.5%, I resemble that. I'm struggling that. But now the difference between me and Troy's father, though, is that I'm not actually trying to say I'm retired.
Sure.
I'm far from that. But I will tell you, this is not one that would freak me out. We'd still need some additional context or context in the fact of, I don't know, is 250 a small part of Troy's father's net worth? I don't know if what the mortgage payment is in relationship to what Troy's father's cash flow or expenses are in retirement. All these things matter, but definitely the 2.5% will have an impact, because we'll try to figure out from an incremental decision making what's the next thing to do with your next dollar. But I would need a little bit more information, but ultimately I'm not panicked about the 250 at 2.5%, but I also don't want somebody like going and taking a new mortgage out at 6 or 7% at retirement. That would freak me out as well.
Yeah, I mean, let's think about this. Let's say that Troy's father is at financial independence and he has a couple of $1 million saved up. If all of that money were in retirement accounts or in 401ks and IRAs and pre-tax accounts, would our advice be, hey, what you need to do is you need to take a giant distribution, the $250,000 plus the taxes, and do that to then go satisfy that mortgage? I don't think that would be incredibly prudent. You're going to have a huge tax bill to do that. So one of the things that I always like to say is that being debt-free in retirement is awesome, but in my opinion, it's just as cool as being debt-free, having the ability to be debt-free. Because even if Troy's dad has a couple $1 million and he's financially independent, and even if a lot of it is after tax, right now, where we exist in our present state, he's got a 2.5% mortgage and money just sitting in a savings account, just sitting in a high yield account right now can make 5%. So I don't think, if that's the circumstance that Troy's dad is in, I think if you have the ability to write a check to pay off the mortgage, in my mind, that counts as unencumbered, even though that mortgage still exists.
Well, but I think it's also intent of the plan. If there's a big difference, if Troy's father was going out, and this is the point I was trying to make earlier, and was about to approach retirement, but he also knew he had to relocate to a different part of the country, or he was, buying his retirement home somewhere else. I don't know that I love somebody starting a brand new 15 or 30-year mortgage right as you're at retirement, because that seems very encumbered to me. However, somebody who's 7 or 8 years into a 15-year mortgage, and it just so happens that their retirement plan has this 2.5% mortgage at $250,000, and it's a small percentage of their cash flow. When I do a financial plan and I'm trying to figure out, does it make sense to extinguish that immediately, or should we do something maybe that's a little more dynamic? Because think about this. While the Federal Reserve is not going to keep interest rates this high forever.
Sure, they can't.
So while there's this arbitrage situation that you mentioned where you can make 5% on your cash versus the 2.5%, okay, let's not prepay it super fast because it's a short part of the plan. But then as soon as the crossover point occurs where now you're paying more in interest at 2.5% than you make on your cash, we'll accelerate paying it back. But it's all within this small plan, this time period of time. That's the big part of this is what's the intent? What's the plan? How does it fit into your cash flow? But I don't want people having debt in retirement. But I also am not going to say pay it off yesterday when maybe your plan has you pay it off in the first 3 to 5 years of retirement.
Love it.